Today, we'll cover the basics of risk management while day trading and scalping. I'll mainly look into 10 different trade cases, 5 high probability trades and 5 low probability trades. We'll learn that how can we adjust our risk due to the charts and decide what kind of trades that we can take, how to avoid unnecessary trades and losing money. We have so much to cover. If you are ready, let's start. Welcome our free trading course, all about price action trading strategies and smart money concepts. With this video, I'll cover the basics of risk management. If you are looking for a structured table of contents, I set it up for you. You can find it on Google Drive or directly from my website, which is in the description. It is important to watch videos in order so you will not miss anything. Okay, let's start with the trade case 1. Let's look at this structure closely. You can see that price action consolidates in a small range. However, it is leaving almost equal highs and lows on both sides. There's no clear stop loss hunt in any direction. Then you notice that there are some internal structure breaks before any major liquidity sweep. Create some imbalance and some small structural changes. This trade is immediately a low probability trade in my eyes because it has no clear intention or liquidity sweep. These are the trades that you may want to skip by not taking the risk or just lowering your regular risk by 0.5% because this range can deviate on both sides at any moment. Let's see another trade case. Imagine there is a very strong demand area in high time frames. An order block, a breaker block, or a mitigation block, or a major swing low being hunted and liquidity swept. Then the price makes a very clear break and then a pullback. Now, if you have a very clear target, like in this case, such as an equal high and imbalance combo, I would call this trade a high probability trade. I would use my regular risk amount, which is 1%, or even I can increase my risk by 0.5% more. So as you can see, I increase and decrease my risk depending on how clear the setup is. Let's see another case that is very similar to the previous case. Now the structure makes a strong break and right after that creates a break of structure. Ideal conditions to look for a long trade, right? However, once I see an equal low with an imbalance below, this creates a natural huntable low area below. This immediately brings the idea of a low probability long trade right here. Even though we have perfect long conditions, this little tiny trap occupies my mind. So, why take the risk here? Or if I really want to enter the trade, I should reduce my risk here. Now, this one is one of my favorite trade setups. Price reaches a very strong demand area or clears a major institutional swing low, sweeping all the liquidity like a swing failure pattern, then creates a market structure break with a pullback with great imbalance. However, what makes these setups great are the targets. You can notice the liquidity pool above, many open liquidity points and imbalances. These are natural price magnets that pull the price. You can see in my real trades, so many of them are based on this trade setup. Now, this is a momentum-based setup. Sometimes in your charts, especially in low time frames, you'll see that prices keep making higher highs without sweeping previous swing lows. You'll see this in cryptocurrencies a lot. This is the basic structure of a pump. It is either caused by a big news or economic events, or the price just being pulled by a big supply here. If you can catch these moves as early as possible, it is great. But if you are too late, it just increases your risk of being stopped out, because it naturally leaves giant imbalances behind with many open swing lows. Again, the question is simple. Why take the risk? Why? Remember how many times you lost money with FOMO, fear of missing out. Most people who lose money in the markets are actually those who enter really late. Another great setup that I really like. This setup is actually based on inducement. Once the price reacts to a high time frame demand, you'll see that price makes a quick reaction. It will be creating these liquidity pools, small compressions. And most of the time there will be imbalances right below them. And the price clears and sweeps the liquidity pool and touch the imbalances. These are great entry points for us. Now, this is a situation we all encounter. In a clear uptrend, price retraces back to an important demand area or a very significant imbalance. Great place to look for an entry, right? However, if the reaction is extremely close to a significant swing low and starts to rise from there, I immediately have my questions in my mind. Why don't you take the liquidity right here, while we are so close? This creates significant risks for us. Why take the risk? It is best to skip this trade and wait for stop loss hunt, or we can easily reduce the risk and manage our account. This is one of the other concepts that I really like to check out. SR flips. When I see a significant consolidation period that broke strongly after a liquidity sweep, I know that these are great places to look for trades, because SR flips are natural breaker block creators. Actually, both SR flip and breaker block are connected to each other, almost the same thing. So, these are places that I look for nice trade setups, which increase my winning trade chances. Nice structures that we should watch closely. Sometimes you'll find yourself in a dilemma, a complex situation. Price gets a strong reaction from a high time frame demand or an imbalance or any other significant price structure, and then creates a market structure break. But right after that, it creates another smaller market structure break, however this time a bearish one. Now, if the price reacts to a very strong high time frame demand area, there will be a reaction. It is almost proven. Why will you trade against it? Unless you see a very clear setup. Can you take it? Possibly yes, but with reduced risk. This is how you keep managing your risk continuously, by giving clever decisions. Finally, let's check one more setup. A setup that combines the range and power of 3. Now, once the price clears a major swing low or reacts to a demand, you'll see a market structure shift. However, after that, price will start to consolidate and create a range for a while, confusing a lot of people. These are the times when you must be patient. Let the liquidity be swept first. As you can see, this is a range plus deviation here, or a smaller form of a power of 3 concept. These are naturally high probability setups to take trades. One of my favorites. Okay folks, with this video, we completed the basics of risk management and how to identify high and low probability trades. Very useful methods for day traders and scalpers. I hope you subscribe to the channel and like the video. Thank you, please take care and see you soon.